Hey, what's going on, everybody? It is Aaron Trevino here, and we have a terrific guest. We have Nicholas from here in Austin, Texas. He is a multifamily investor. How you doing, Nicholas?
Good, good. Happy to be here.
Absolutely. Yeah, I know this has been in the works for a little bit, so great to see you, and I'm excited for this one.
Yeah. Glad we could finally make it happen.
Absolutely. And I know we talked about it a little earlier, but that's not you're not in the mountains right now, are you?
No. Certainly wish I was, but no. Still here in Austin.
Okay, very good. Now, yeah, if you could just, introduce yourself a bit and tell us a bit more about you.
Yeah. Um, so I've been investing in real estate since about 2015. Prior to doing this full time, I was a technician for Audi and Volkswagen for about 11 years. Failed engineer. I went to college and started down the engineering path, dropped out. Thought I wanted to work with my hands, and 11 years later realized that wasn't what I wanted to do for the rest of my life. So I started investing. I got lucky because I lived in Austin, so I started investing in Austin, and it's been a terrific market. Um, I moved from single families, house hacking to duplex, which I actually currently still do because I just enjoy it so much. As far as cutting the cost of living, and slowly scaled my way up to buying multifamily. I found a great mentor to kind of help me down that path, and since then we've closed on over $23 million worth of apartments here in Austin, and I do this full time now.
Absolutely. So for those of us who don't know, could you kind of, define what house hacking is and kind of your process?
Yeah, sure. I think there's a different couple explanations for it. The way that I've done it, and it might not be traditional house hacking. Maybe it has a different name, but I bought a duplex and I just rent out the other side. And essentially, the biggest impetus to doing that for me, because I was living, I had a single family I was living in. We ended up moving out of that, renting it, and then house hacking a duplex, was that it completely covered, the cost of my mortgage. So essentially, I was living in the other unit for free, which was, a huge uh, weight off my back when you're trying to transition from your W-2 into full-time real estate investing.
Absolutely. That's definitely a great thing. How you mentioned, it kind of takes some weight off your back.
Oh yeah,
Absolutely.
definitely.
So you transitioned from house hacking and then you were doing flips as well?
No, I've never done a flip. Everything I've done has kind of been longer term buy and hold. I've certainly sold them on some short time frames, but never on the time frame of a flip.
Okay. Is there something about flips that you didn't really take a liking to, or you just had interest in something else?
Starting out, I had my own capital, and I really enjoyed the monthly cash flow model of it. I've got nothing against flips other than I didn't really gravitate towards it. I don't know why, honestly. It just the thought of holding and having something bringing in monthly, streams of income just appealed to me more than just a single, commission.
Sure, sure. I guess that makes sense given that, you had just mentioned how you found out you didn't want to work with your hands.
Yeah, that too. That too. I've tried doing my own projects around the house. I know that's not a skill I have, and certainly not one I want to spend time to develop.
Okay, fair enough. What sort of projects have you done around the house?
Well, I've tried, remodeling bathrooms, flooring, painting. I always think I can paint, and I always tell myself when I'm done painting the house that I'll never paint my own house again, because I hate that process. But simple stuff like that. But it always takes way longer than I expect. It never turns out the way I'd like it to, and I always end it with thinking, I should have just hired somebody to do this. What a waste of my time. But yeah.
Fair enough. I guess there's a lot to be said for finding, finding someone who knows what they're doing, whether it's a business coach like you had or whether it's a professional painter.
Yeah, exactly.
So I'm just curious, how were you able to link up with this mentor coach that you had?
Yeah, so it was kind of just a natural progression. I had heard them on Bigger Pockets when I started listening in 2014. And they had their own podcast, so I'd been kind of following that for a while. And it was about apartment investing. It's Jake and Gino, for those who out there who know them. They have the Wheelbarrow Profits podcast. I've been listening to that for years. I'd always felt like the path to apartment investing was start with single family, buy as, get up to like 50 or so, and then, sell those and transition to apartment investing, um, into apartments. Um, and so while listening to their podcast, I never really took action on the multifamily side, until, late 2018 is when I started seeing, I had all these equity in a few houses here in Austin and Round Rock actually. And it wasn't really doing anything for me, right? I was getting a few $100 a month in cash flow, but the amount of equity I had in the house really didn't justify the return, right? I could do so much more with that. So I was looking at selling that, transitioning into something larger. And that's when I finally took the plunge into reaching out to them about mentorship.
Sure, absolutely. I'm just curious, what's kind of your, was there a moment for you or a big motivator that kind of said, hey, I'm going to go ahead first and I'm going to do this?
The year before that I had bought, actually not even the year before, about 6 months before going into multifamily, I had bought a turnkey in Memphis, which has been doing fine, because I thought, with the returns I was getting in Austin going forward, as the margins were getting tighter and tighter, especially I was in Round Rock and Pflugerville, um, which I guess is in Austin, the Austin MSA. Um, it was a lot of work, especially while working full time, finding a deal in the single family duplex space that made sense. So I bought a turnkey and thought, that would be my process going forward. And then I just realized it was very boring. And, that's not a bad investment strategy. Some of the best investments you make are boring ones, right? But I enjoyed real estate and I realized, I got to find a way to do this to where I can be more active in the process.
Okay. Could you kind of expand a bit more on, what would you consider exciting in a real estate deal, or what do what do you want to do?
Yeah. I mean, I love the deal finding aspect of it. It was getting frustrating because I couldn't find anything that worked. And I think I let that frustration kind of overwhelm the joy of it. It's kind of like, there were other strategies out there that did work that I wasn't pursuing. Right. I mean, I guess I could have gotten into flips or wholesaling. That's not really where I feel like my talents lie. But I love finding a good deal. I love, and now I like finding partners and bringing projects together. I like running the deals. That's what I do pretty much full time now. We have third-party property management. I'm the asset manager, but I'm very involved because I just kind of like seeing how it evolves over time. And I'm a kind of a numbers geek when it comes to it as well. So those are the aspects I enjoy. And with turnkeys, you don't really get a lot of that, right? It's kind of all laid out for you. And you don't get, personally, as I'm realizing over the years, you don't really get the equity appreciation you would as running your own projects, especially in a good market, right? It's been cash flowing well. I looked at selling it a few months ago, sorry, and it hadn't appreciated at all. So all the cash flow coming in is nice, but the cash flow pays the bills, but it's not going to make you rich, right? For at least in my opinion, I want that equity.
Sure, absolutely. Could you kind of expand a bit more on that, on, what equity is and equity appreciation?
Yeah, sure. For me, I want that ability um, to kind of, first of all, I believe in the power of leveraging smartly, right? So if I can take my money and use it the most efficiently, the best way to do that is leverage. And if I can do that in a market that's either appreciating or I can force the appreciation, I can make that down payment, the money that I put into the property, go further, right? So I can recycle it either, through pulling it out through a refinance, whether you're pulling out, 100% or 50% of your initial capital, or selling and rolling it into a larger project, whether through a 1031 or just moving into something larger. So that's really what I'm looking for on the equity side, is taking my initial investment, making it grow as large as it can, and either pulling it back out to put in something else to create another stream of income, or rolling it into something larger so that stream of income is larger.
Sure. So when you say into something larger, could you kind of expand on what a 1031 is?
Sure. Yeah. So technically, my partner has taught me a lot about 1031 because that's how he's been so successful in building his portfolio. You sell, especially for what we do, you add a lot of value to these projects. So we bought, a 53 unit and a 71 unit in Austin last year. And my side didn't come through 1031, is through a normal sale. It was a house that I'd lived in for at least 2 years, so I was able to dodge the 1031 rule with the amount of gains that we had. But he 1031'd it, but it's basically we added 130 or so units out of a 12 unit building, right? So that's what I mean by going into something larger. You take those gains and you roll it into something larger. And even if your cash on cash is still low, or is low, especially in markets like LA and Austin, that, it's still relatively large considering the size of the project, especially from what you started with.
Sure. Could you expand on also, why in markets like LA and Austin, why is the cash on cash lower?
Yeah. There's a lot of reasons. Demand, is a big reason. We buy, one of the metrics we use to buy is cap rate, right? And the theory is the lower the cap rate, the more secure the investment, or at least that's the viewpoint from the investor side, right? The more they're willing to pay for that income stream. Now there's factors that go into that make that not true, right? You could be doing a value add where the cap rate, maybe if it's steep enough, isn't really that reliable of a metric to use. But typically it's location based, right? Especially when it comes to LA and Austin, these are really great markets. No matter what you say about California laws, coastal real estate is still very expensive and very desirable, both worldwide and nationwide. So it primarily trades at lower cap rates because it's viewed as a less risky investment over time.
Absolutely. So I know you mentioned how your metric was cap rate. You're also looking at cash on cash. Could you kind of explain what cap rate and cash on cash are?
Yeah. So actually the metrics we really look at are cap rate and cost per square foot. And the reason we do that is because we want to know where our markets are trading at cost per square foot wise for the age of the asset and the location of the asset. And typically we'll see, because we do value add, if you see a good cap rate but a high cost per square foot, that usually means somebody's come in and done the value add, right? They've increased the income. So it might be looking at a more stabilized, attractive cap rate, but the cost per square foot is high, meaning there's probably not as much meat left on the bone for the next investor if you're looking to do a value add deal. And what I mean by cap rate is basically the net operating income divided by, the purchase price.
Sure, absolutely. And then could you also describe what cash on cash is and how it
Oh
factors
yeah.
into
Yeah,
that?
sure. Basically, for us, it's the return on all the cash invested. So not only the down payment, but what goes into all the closing costs, all the renovation costs, what the amount of cash you invested, what are you getting back annually percentage wise?
Okay, very good. So it sounds like you're hunting for these value add projects strictly, right?
Yeah, especially in these tight cap marketplaces, because that's where our dollar is going to work most effectively, right? The lower the cap rate means the more dollars. Lower the market cap rate means the more dollars I add to the NOI, the more I increase the net operating income, the more I increase the value of the property. So in 2 to 3 years, when we go to refinance, we can pull most, if not all, and then some of our capital back out and still own that deal.
Okay, understood. So I'm just curious, that 2 to 3 year period there, is that the amount of time that it takes to do the complete value add, or why do you choose to refinance in that period of time?
Yes, it depends on the project. We had um, three buildings in LA that we were able to do our refi within a 12-month period. And that was awesome, especially for the investors. But on the flip side, it typically takes, depending on how big the project is, we estimate it'll take us 2 to 3 years. And there's also things like debt that goes into it, the type of debt we perceive. We're not a big fans of bridge. So we usually do either a community or regional bank. And so with our prepayment penalty, and this might be getting into the weeds a little bit, but we try and pursue a step down. So year 2 or 3 is usually when our prepay goes to 1 or 1.8%, which means our refi costs a lot less. Also, we're not in LA, there's rent control laws and things like that. So when it comes time to turning tenants and doing the rehab and the renovation, that process takes time. We have to buy out tenants. We have to jump through a lot of hoops through the city to get those units brought up to market rent. And then in Austin, we're kind of doing our value add as the units turn over organically. So we're not going in and canceling leases when they come due. We're doing it on the turns, and typically that takes about as we're seeing 2 to 3 years.
Absolutely. So when you say organically, you mean that you're not terminating the leases, you said, right?
Yeah. We'll increase, it depends on the state of their unit and how far below they are market rents. It's a case by case basis, but typically we're increasing them, the rents at renewals, with as much as we can on market rates. If they decide they don't want to pay that and move out, then we'll go in, do our upgrades, and rent it out at the higher market rate. But we're not just canceling those leases when they come up for renewal and doing a non-renewal.
Absolutely. So, when you say you're going to go in, you're going to do a value add, what exactly is a value add, and where do you start to add value to the property?
Yeah. That's kind of a loaded question. We do have a resource that we've given to our investors and people are interested. It's on our website. It's our 10-step value add plan. If you go to quantumcapitalinc.com and go to our resource page, that's available for you. But to go over it, you kind of on a broad spectrum, we're the value add for us is either increasing the income or decreasing expenses, right? Whether it's operational efficiencies or upgrades to the property. We usually pursue both. There's some unique things we can do as well. Things like we do renter's insurance, we do credit repair, all things that add value to the residents without actually, costing us anything out of pocket. But as far as what we get the most bang for our buck out of, it's operational efficiencies, decreasing expenses as much as we can. And then on the income side, it's the obvious unit renovations, building renovations, increasing the income at renewals. And, LA, we do buyouts. So buying out really low rent tenants because there's rent control. We can't just non-renew the lease. We offer them a very attractive buyout. If they accept, we'll go in, spend $10,000, $15,000 on the unit and rent it out for $800 to $900 more per month. So
Fair enough. So you mentioned something about renter's insurance. How would that look? Is that built into the cost of their rent, or what are you doing there at the renter's insurance?
yeah, we have a company we work with that we like. Obviously everybody who's renting units to people should require renter's insurance. There's a lot of benefits that go into that. Most people know that, but it saved us a few times. I know several investors where it's saved in the past. It pays from day one. There's a lot of good things about renter's insurance. And we kind of took it a step further where we work with a company that basically we get discount rates from, and then we can sell back to the tenants. And our spread is about, $1 to $2 per unit. So we're not making much, but that way we can guarantee that our residents have renter's insurance. They're covered. We're covered. It's very competitive as far as the rates go. We do allow them to pursue their own outside of it if they want. And we just have to verify that they have it.
Sure. So do you find that it's better to make it a requirement as opposed to, allowing them to find their own renter's insurance?
I don't know the exact legal aspects of it, but from what I understand, no matter what, you have to allow them to have their own. You can't mandate which insurer they use, but you can require renter's insurance, which is something we do, and then we offer it at our discounted rates as a service. If they want to get it elsewhere, they're likely going to pay more for the same coverage, but they have that option.
Absolutely. And you'd also mentioned something about credit repair as well. Where is that in the process of renting a unit?
Yeah, it's actually a service that we're pursuing right now when we're looking at software changes. But essentially, you offer people to report. It does it automatically. Basically, reports to credit bureaus monthly that they're paying their rent on time and helps build their credit. The residents pay for that service. It's about, I want to say, $4 a month. And we make about like a $2 spread. So it's not much, but spread over 400 units monthly, it's not a bad stream of income as well.
Sure, absolutely. So in terms of the renovations that you make to an apartment, what specific renovations are you making to the unit?
Sure. The first thing we want to do, in my opinion, the best thing we can do is community improvements first, depending on the state of the units. We want to make sure it's safe. The exteriors are well presented. We're buying B and C class, so we're not looking to be the nicest on the block, but we're looking to be an attractive option, a place where people are happy to live. So typically we'll do community enhancements, in my opinion, should be one of the first things you go after. But it also depends on the state of the units and how far your loss to lease is, because that's a big profit driver, right? So as far as unit interiors go, it depends on the area. If it's a C class, more working class neighborhood, we're probably not putting in granite countertops, things like that. But we'll do, upgraded appliances. We'll resurface countertops. We'll put in nice finishes for like sinks and fixtures, things like that. Flooring. We generally put everything vinyl plank now, just to make it easier for us. Very rarely are we replacing carpet with carpet, unless it's like a second story unit and there's been noise problems. But and then on the higher the B class, maybe pushing B plus. Depending on the area, because we do buy some unique buildings in LA, some 1920s ones that are kind of unique architecture. We'll put more into those. We're doing the full turn, full fixtures, full, new sinks, new countertops, new fans, new appliances, stainless steel. We're putting in granite. We're doing backsplashes, and that's typically $12,000 to $15,000 a unit, depending on the size.
Sure. Yeah. So you touched on 12 to 15,000 per unit, but could you kind of maybe walk through what you're looking at when you're making a budget?
Sure. Yeah. I mean, as far as when we're looking at like takeover, or just like a unit, like what we're kind of estimating we're going to spend per unit on takeover.
Yeah, exactly.
Yeah, I mean, it's kind of that same calculation I just went through. We have a crew that does our renovations in Los Angeles, and we kind of, know by now where their pricing is going to come in on projects. And honestly, it's usually about 12 to 15,000 per unit, mainly because we're buying buildings 1920s. A lot of the residents that we're doing buyouts and that are accepting our buyouts have lived there since early 2000s, maybe 90s, maybe 80s, right? So we know we're going to have to go in and turn these full stop. We'll estimate how many we expect will take buyouts. Of those buyouts, how many need a full turn. If they need a full turn, that's when we start doing our calculations, because there's always going to be units that have been renovated, right? And the turns are easy. There's a couple $100, paint and patch. We kind of just build our budget around the ones that we expect to accept buyouts and move out. And it's the same for Austin, except, we're expecting to turn over the entire complex within 2 to 3 years. And so we'll, during our due diligence walkthroughs, we'll kind of build out which units need the biggest upgrades. And, the ones that we've been doing here are much smaller in scope. We haven't been, we buy a lot of, I would say B minus, C-class assets in Austin that have been performing really well. But, typically our budget is $5,000 per unit, and we're not ripping out doing cabinets or anything like that. So we're able to keep those costs a little bit lower.
Sure. Could you kind of walk through the different classes, A, B, and C types?
Sure. Yeah, I'll do the best overview I can. I think it's kind of market specific. You're looking at the area overall, your tenant demographic, and then you want to go into like vintage of buildings, right? That's the biggest classification of it. C class is your older, more dilapidated buildings, stuff that like you see more working class, blue collar jobs at. B class is usually a mixture of the white collar and blue collar. It's usually in the nicer neighborhoods or on the fringes of it. 1980s and above, all of that varies. We have some 1920s buildings that I would classify as B class because of the amount of renovations we put into them. And then A class is, your brand new, nice products with all the amenities, the bells, the whistles. That's not something we've pursued yet, is A class properties.
Sure, absolutely. So what sort of I know you've kind of walked through different multifamily projects, but what are you working on right now?
Yeah, with the onset of COVID, we've kind of slowed down acquisitions. Surprisingly enough, Austin seems to be faring pretty well, all things considered, with the shutdown and all the unemployment. I think we're back down to like 6%. I saw the other day in the city, which is pretty astounding considering where we were a few months ago. Um, so we're hoping acquisitions on our side will pick back up, but we're being very cautious about it. Same with LA for different reasons. The shutdown's still going there. We haven't had too much of a problem with delinquencies on our properties, but there is some legislation coming up in November that's kind of putting us on pause from doing syndications. We did just close on two smaller apartments there, a 22 unit and a 70 unit that we did in house. So we're kind of focusing on that project for now. But really lately, it's been a lot of just making sure we're running as lean as possible and staying as occupied as we can.
Of course. Could you explain what exactly the legislation is saying?
There's a lot going on, and I'm probably going to miss out on certain aspects of it. But essentially, anytime there's a lot of renters protection things on the ballot, especially when it comes to our ability to raise rents, turn at vacancies, eviction, harshening eviction laws, limiting the scope of yearly increases. There's already rent control, but the legislation that gets attached to it, and then the possibility of repealing what we feel to be a very fair and favorable tax law has kind of caused us to put a pause on accepting investor capital for those deals, unless we find just a screaming deal. It just doesn't seem worth the risk.
Sure,
Um,
absolutely.
yeah.
So could you, I guess, given that you've done business in California and Texas, could you maybe kind of elaborate on a few of the differences that you have to look at between the states with multifamily?
Yeah, yeah. Outside of the biggest one, which is rent control, right? Obviously, LA in general, but also California is a much more tenant-friendly market. So you have to make sure that your property management company, or if you're managing it yourself, is well versed in all the laws, handles everything to a T. Because the last thing you want to do is be involved, be on the news, right? As a slumlord or anything like that. So definitely the tenant laws and profile in California is different. The more favorable aspect of California is property taxes, not the income taxes, right? I guess that's harder for everybody. But on the property side, the taxes are much more favorable. Property taxes in Texas, Austin is the one I can speak from experience, are very steep and very expensive. And honestly, it's our biggest line item and our biggest and not to go on a soapbox, but I think it's the biggest barrier to affordable housing and the reason for the sharp rent increases across not the country, but the state of Texas, because taxes are very high and burdensome,
Sure,
as opposed
absolutely.
to LA, where it's almost half of what we would pay on a similar building in Austin.
Okay. Yeah, it's interesting. It seems like it cuts both ways because you have, the higher property taxes here in Texas, it's lower in California, but yet the cost of living is lower here but higher there.
Yes. Yeah. I mean, there's definitely things we said about no state income tax. That's great. The cost of living is definitely lower. But from a property ownership side, the taxes can be quite burdensome.
Sure, absolutely. So in terms of other, factors or little intricacies that you have to think of, between the two states, what are the other differences between California and Texas?
Um, hmm. I mean, most of it for me just comes down to costs. Austin is a very young millennial city, so we see some of the same tenant profile at our buildings that we would see in let's say like Los Angeles. A lot of the cost to operate are significantly lower in LA for your fixed costs, your taxes, your insurance, um, as opposed to Texas. Our taxes and insurance are large and they grow larger every year. Um, there's a few operating characteristics that are weird. Any building 16 units or above in LA, you have to have a resident manager, so you're accounting for payroll on the property. Usually, it's just a couple, $100 off rent, but it does make it unique when you're looking at buildings. Whereas, in Austin or Texas, you can choose to have a manager on site or not, depending on the size of the project, if it's worthwhile. And then, while LA is a very developed market and we've seen rents continue to grow out there, Austin is definitely a more of a growing market. There's a lot more room for it to expand. It's a lot, I would say, younger in its growth. So I think there's, in my opinion, more opportunity out here if you're looking at from the growth perspective.
Absolutely. So are you looking more so infill in the metro area, or where, what part of the greater Austin area do you think will grow?
Well, you know what I like? You could throw a dart at Austin. You'll pretty much hit an area that I would buy in. There's very few that I stay away from. I like the whole MSA. Honestly, I see great growth in the Round Rock area. I've always been a fan of that area, especially with the resort going in. And it seems like the growth of things is kind of naturally pushing more north. Where we've bought is kind of closer to downtown, and I will continue to look at assets in those areas. I love like North Campus, Hyde Park North Loop. Those are the areas I really like. East Riverside Corridor, tons of growth going on there. It's kind of hard to pick an area in Austin and not see some reason to invest there, right? Especially right now. But if you had to pin me down to one spot, I really like the North Austin area when we're around like the Domain. I think, there's just so much going on up there. Even if you count in like the Parmer development, I would love to continue to buy some stuff up there.
Sure, absolutely. Do you do any sort of new construction at all, or is it strictly just the value add?
Yeah, right now it's strictly just value add. I would love to get into that someday. I would need to find a mentor or a coach of somebody who's done it, because that's just not an area I have any experience in. But I think there's definitely opportunity, especially as prices continue to rise in all asset classes, but B and C class, you're going to get over the replacement cost and cost of land soon, and it would be more advantageous to build new if you can swing it.
Sure, absolutely. So kind of going back to to you having that mentor or coach, what specifically did they kind of clear up, or what are kind of the benefits of having a coach like that?
Yeah. I am such a big fan of coaching and mentoring now, but starting out was not, right. I've been listening to Bigger Pockets for years, listening to podcasts, reading books. And I thought, any information, and this is true, any information that you need is out there on the internet, right? Or somebody has it that you can get it from. The difference is, and I'm a mechanic, so I'm going to always relate it back to mechanic lingo, but the overall picture, right? Most of us know how a car works, right? You can get in, you can start the car, you can drive it around. And most of us know how real estate works. You understand, hey, I find an undervalued property. I buy it, I fix it up. I either continue to rent it out, refi, sell, at that point, unless you're wholesaling, which is another thing, but most of us get the picture of how real estate investing should work. What are the nuts and bolts? How does that work? Right. And that's where I needed a mentor and someone to help clear that up, because sure. Okay. I should buy an apartment complex. Who am I going to talk to even start looking at those deals? How do I find financing? Who's going to fund it? Who's going to run it? How do I handle insurance? How do I handle all these costs? How do I even know if it's a good deal? What am I looking for? Right. All the action steps that a lot of us take for granted when looking at the big picture. That's what I needed help on. And that's what a mentor and a coach has kind of cleared up for me. They've also changed my mindset to look at bigger things and really expand what I thought was possible. But it always related to me back to action steps. What do I actually do to make this happen? Right. Because like I said, the concept makes sense, but what are the nuts and bolts?
Sure, sure. Just curious, what did you previously think was impossible that they kind of opened your eyes to being possible?
Yeah, I thought I had to do everything. I thought I could do everything myself, and it made more sense to. And as you grow, there's definitely benefits to doing as much as you can in house and by yourself. But I'm now a big fan of partnerships, which I used to think were kind of elusive and not worth it. And also buying bigger than I thought I could. I was looking at selling the properties that had a lot of equity in them and buying out of market because I thought I couldn't afford Austin. So that was a big mindset change there. I was looking at tertiary markets where the cost per unit was a lot cheaper because to me that meant better. So that kind of changed my mindset on that. Right, cost per unit is kind of it does not lower cost per unit does not mean a better investment um, in and of itself. Um, but yeah, I mean, I kind of got lost there for a second, so I apologize. But a lot of it was action and mindset based, like going after. I've closed on over 200 units now, um, whereas my goal before was to find like a 12-plex that I could buy myself and operate out of market. So
Absolutely. If you don't mind, could you maybe run through, your first deal that you did, how you found it, and the end result?
yeah, yeah. A big caveat I put here is I was working full time, and so as I mentioned before, I'm a big fan of leverage, both in time and of money, um, as long as you're doing it wisely. So there's other acquisition steps people can take, but for me, the best bang for my buck at the time was developing relationships with brokers, because I still that's where we get 99% of our deals is through brokers, because I feel like they're spending all day every day developing those relationships with owners in the area. If I could develop one good relationship with them, I could leverage their relationship with the owners, right? As opposed to going out and trying to find off market deals myself. Now, people have been extremely successful in it, so I'm not saying you can't do it that way, but that's how I've found all of my deals through building those broker connections. And it was no different for the first deal. It was brought to us by a broker. I just happened to reach out at the right time. I typically try and reach out to brokers. I have them on a rotation, unless we're working on a deal where I reach out, every 2 weeks. It just so happened when I reached out to this broker, it was when he was putting this deal together. So I got a first look at it. Drove out that afternoon on my lunch break to meet him for a tour. It was a 53 unit in Austin. And it was and we've offered. So at this point, being my first deal, and I apologize for rambling, but at this point, being my first deal, we had offered on tons of deals. We looked at a lot. I had already met my partner through this process. We've offered on a few deals together. And so this was our first one where it felt like we were getting some traction, and that's when I felt like it was really becoming real for me. But brought to us by a broker. I drove out there on my lunch break. I liked the deal. From what I saw from the numbers, it made sense. I went home that night and underwrote it, called my partner, and we put together an offer and had it out the next day for the property before it officially hit the market. So we were already negotiating and putting under contract by the time they had the OM, the offering memorandum, put together and started to list it. So that helped us getting the jump on it and moving quickly. And then, yeah, closing it was definitely different than any single family or duplex or turnkey I've ever done. The process was it was a very stressful, well, it turned out to be 75 days. Learned a ton. And all I can say is on the buying side, don't overestimate how helpful it is to have your team set and ready to go to do due diligence, because I thought, we'd have no problem getting it done. I thought I had most of the pieces in place, and then quickly realized that was not the case. And it was a very stressful due diligence period trying to get the inspections done and get insurance and all that stuff squared away before we had to remove contingencies. Yeah, and that was the first deal. And since then, while we were still closing that one, we had an off-market deal brought to us by a broker, which turned out to be our second deal. And then while closing our second deal, we had another one brought to us before it hit the market through a broker connection that ended up being our third. And all of this took time. I mean, we identified the first property in April, and I think we closed the last one like right before the end of the year. So it's a long process from finding it, negotiating, closing, and and eventually getting the keys.
Sure. Yeah. I'm just curious as well. I know you mentioned how it was a bit difficult to get the inspections done and have all those things done. How exactly do you set yourself up to have a smooth transition to closing?
Yeah, I think one thing that's helped us a ton now is we have our property management company that we use, and they help a ton with the due diligence. So we know when we're about to, go under contract on a deal, we've already got them ready to go. Right, going into this first deal, we didn't have that. We had talked to a few property management companies. We weren't sure who we were going to use. We didn't actually decide who we were going to use until about 30 days into due diligence. If you know who you're going to use before that, it helps a ton. They help with the lease audit. They'll help with the unit walkthroughs. As long as you use them on the property. Generally, depending on the size of the building you're buying, they'll help with all those things free of cost. There might be a charge that helps a ton. Knowing which inspection company you're going to use as well, if you're going to do a third-party inspection company outside of your unit walkthroughs. We ended up calling 5 or 6 to try and meet our deadline, and finally one came through to meet our deadline. But it was tough. It turns out their availability wasn't as open as I anticipated. So having that planned out beforehand helps a ton. Inspection companies, you can start talking to them now and get recommendations for good ones to use. But I would say as you start looking like you're going to go under contract or maybe negotiating contract terms, that's when it's a good time to start reaching out to them and get their availability and make sure that they can accommodate your schedule instead of you're under contract, the clock's ticking, who are you going to use? Those were the big ones. I mean, insurance and everything, finding insurers in your areas, usually get broker, get investor recommendations, but you can take your time on that a little bit more to get that put together. But the big ones, property management and how you're going to do your due diligence. Also your vendors. I mean, this is where a good property management company comes into play, but who's going to look at your roofing? If you're not using a third party inspector and you're using just your walkthroughs and your independent vendors, who's going to look at the foundation? Who's going to come out, look at your boiler rooms, and maybe there's somebody on your PM staff that'll come out and do that. Like for us, they have a GC that comes out and walks the property to look for all life safety issues. But getting that team put together, or at least have an idea of who you're going to use beforehand, helps a ton.
Absolutely. So is the idea to kind of, stagger it? Like, do you want your inspector to come out one day, or, during that option period, what's kind of the frequency of people coming out to evaluate the property?
Yeah. I mean, you want to be respectful, but also you're buying the property. So definitely there'll be notices on how much time you have to give them, who can come out and when. You kind of figure that out during your PSA stage, your purchase and sale agreement. We try and coordinate all the on-site inspections for one day, right? The day we're going to do our walkthrough is the day we want the roofer to come out, is the day we want the foundation guy to be there, is the day, we want the GC to walk it with us, because we'll have everybody on site and we can kind of collect everything into our report that day. We can do our lease audit as well. Typically before that point, accepting the lease audit, we've already done our financial audit if they've gotten all the resources to us. But as far as on-site inspections, we try and get that done on the same day. Now, it's not always the case. You might have your roofer need to come out at a later date, as long as just make sure you find somebody within your period so you can still make, your decision.
Sure. Absolutely. And could you also touch on, you'd also briefly described how you underwrote the deal, and then the next morning you put the offer in. How exactly, would you say you underwrite the deal? What are you looking at?
Yeah. Our process has evolved a lot since then for what we're looking at in Austin. But it's kind of going back to what we're looking at before. What's the price per unit? Is it good for the area? What's the cost per square foot? What's our going in cap rate? What do we expect we can raise rents to? How are we going to operate this? How efficiently can we operate this? And for your first deal, you're making a lot of assumptions, right? You might have read, done all your research, talked to local investors, but you're still assuming on the operation side and on the rent increase side that, hey, we can do it this way. And that's why it was so important for me for the first deal to not use investor capital. And actually all 3 deals we've done in Austin have been with our own funds in-house through partnerships. But especially on that first one. But not to get sidetracked, we're looking for sizable differences between market rent and in-place rents. We're looking for a clear path to achieve those. And if it's not a clear path, how much is it going to cost? And factoring that into our offer price. What's the deferred maintenance on the property? And some of it you'll find during inspections, but generally through your tour, you can identify big risks like foundation, some life safety issues. Are there breakers? What's the wiring like? What's the plumbing situation? You'll get a lot of that from the property manager when you're doing your walkthrough if you ask the right questions. And that's what stuck out to us. It was in an area that we like. There's tons of development going on. The price per unit was slightly higher than we would have liked, but it still made sense based on the operating financials. And there was, a sizable upside in rents.
Okay. Very good. Very good. So that sounds like that's mostly what you're doing right now. What are you looking to do in the future?
We found a lot of success in the Austin market in the 50 to 100 unit space. We're continuing to look at deals around that size. But as we've grown and as our investor interest has started to peak, we've started looking larger and larger. We've offered on a few 200 plus unit complexes, and I'd really like to find one that we can take across the finish line.
Absolutely. Is there anything that you haven't said so far that you'd really just like to hammer home?
The biggest thing that kind of helped me moving forward was networking. I know we didn't touch on that too much, but it's how I found my partner. It's how I've identified my mentors, my local mentors in the area who have helped me a ton as well. I can't stress enough how important and vital it is to start building a network of like-minded people. Even if you feel like, don't go out there for selfish purposes. When I was reaching out to people, I was just seeing if I could help them in some way and hope to learn a little bit. Right. I feel like, and most people, and maybe this might be different for everybody, but from where I was, I did not have a circle of people trying to do a lot better in their lives, right? Everybody tries to do well, but nobody really trying to push that next level. Nobody interested in real estate investing. And once I started reaching out to real estate investors and people who were trying to achieve that next level, the growth just took off. So in my opinion, that's where you should start first, is just start reaching out and meeting people, doing what you want to do.
Absolutely. It's definitely really important. So Nicholas, maybe someone's watching, they're impacted by what you said. They really like your explanation of value add and multifamily. Where can we find you?
Yeah. So, my name's kind of unique, Nick Ameluxen. So if you search that, I'm definitely going to be the one who pops up. There's not a lot of us Ameluxens out there. But the easiest way is to, either email me, which is just Nick, Nick, at quantumcapitalinc.com. That's also our website where we have that 10-step value add process that we use, that we've crafted, my partner and I have crafted over his 20 years of experience, that, I would recommend people grab if they're interested in our version of value add and kind of how we work our process. And then we also do a podcast ourselves called the Wild West Real Estate Show. It's hosted by my partner, Mark Intman. We've had some, interesting guests on and takes on, and I would recommend that as a resource as well.
Absolutely. I'd be happy to put that in the description.
Awesome. Yeah. Appreciate that.
Yeah, absolutely, Nick. Well, thank you so much. You've been a terrific guest. I've learned a lot, not only about you, but also about multifamily value add. And basically you ran the gamut, and it was terrific. So thanks.
Yeah, thanks for having me on. It was a good time. I know I rambled a bit, but I always enjoy, having these conversations. So thanks for giving me a platform. I appreciate it.
Absolutely. We'll talk to you soon, Nick.
All right. Have a good one.